Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now, much of the market focus, of course, has centered around the geopolitical events in the Middle East and specifically for the focus on the channel to financial markets through the impact on energy prices. Now, we published several sort of notes over the course of the past week detailing, different scenarios that pan out. But today we're very lucky to be joined by Heung, who's a senior investment strategist in the CIO office, to help sort of update us in terms of the current environment and, of course, where we see opportunities in markets related to the situation and of course, looking beyond that as well. So thank you, Ray, for taking the time to join us today. Let's kick off with, the biggest headlines. So this week, Middle East conflict, of course, is where a lot of the attention is focused. So could you provide us an update on your view and your current thinking around that from a market point of view?
Thank you, Manpreet, for having me. And yes, actually, the impact of the situation and towards the market has been quite manageable thus far. If you look at this point, oil and gas shipment probably are virtually halted through the Strait of Hormuz. Crude oil prices have risen to around $80 per barrel. But I think if you look at the historical signs, let's say using the Ukraine war in 2022 as a benchmark, at that time, the crude oil actually hit over $100 per barrel. So meanwhile, if we look at other risk assets, they have responded in a fairly measured way. Global equities are down by about 2% since the start of the conflict, while U.S. equity are little change, given U.S. is a status of net oil importer. Now, if you look at Europe and Asia, equity has underperformed a bit. Largely, I think, because the two regions are actually net oil importers. If we look at the bond market, the U.S. 10 years government bond yield rebounded almost 20 basis points from last week, which is a 11-month low back then, while the U.S. dollar index, which is DXY, extended gains since late January to break about its long-term 200 moving average. So our base case, if we look at it at this point, is that the conflict to us will probably last over a few weeks instead of months. And so we expect oil prices to drop back to pre-conflict levels as the crisis subsides. Now, given global oil reserve remain ample, so this will be one argument that we would like to point out. But the key, obviously, is how soon the Strait of Hormuz becomes safe enough for oil and gas tankers to navigate. Since almost 20% of the world oil and gas pass through the strait, President Trump now proposed military assistance and insurance guarantees so that shipping resume along the strait could be possible, although that implementation could also be taking weeks to happen. Now, again, this backdrop, we think that maintaining our core risk allocation and building hedges against inflation spike would be prudent and amid the uncertainty.
Okay, thanks, Ray. I suppose if I take that one step further, one market concern is about the impact of some of the oil price scenarios on inflation. So from an investment strategy perspective, how would you suggest investors tackle these sort of risks?
Yeah, thanks, Manpreet, for that question. Surely inflation will be closely watched in our view. The main market risk is actually a sustained rise in oil price that lead to a surge in inflation expectation, pushing back estimates of the Fed rate cuts. Right now, if we look at the near-term inflation expectations, that has rebounded already quite modestly. Now, using the U.S. one-year inflation swap rate, they actually move up by about 20 basis points. And this is actually jumping a little bit more than the long-term inflation expectation. This to us suggests the market is actually viewing the oil price impact to be shorter term. Now, data-wise, I think U.S. core consumer prices inflation actually increased by 3.6% in January, which is implying a revival in inflation. So in terms of hard data, I think next week consumer inflation data will be keen awaited by the market. Now, as we also mentioned earlier, our base case is that the Middle East conflict unlikely to last for too long. We're expecting only for a few weeks, and especially given Iran's depleting military capabilities. Now, as the U.S. plans to provide military and insurance assistance to resume shipping through the Strait of Hormuz, that should help easing concern about a sustained disruption in the Gulf oil supply. So in this scenario, we see limited lasting impact on inflation, and that would enable the Fed to resume rate cuts into second half of this year and to revive a soft job market as driven by the tariff and also inflation is fading. In terms of recommendation, our recommendation is still to maintain a core allocation while building hedges against any inflation spike. We do believe the US dollar asset would benefit from a sustained rise in oil prices, given the US is a net oil exporter. We expect the US aerospace and defense sector equities, energy sector equities, and inflation protected bonds to perform if the uncertainty continues. We will also be buyer on gold on dips, as it remains a structural hedge against geopolitical situation. Although Europe and Asia would be most impacted from any sustained spike in energy prices, given just we mentioned about their net energy importer status. We think that equity sell-off in this market will create value opportunities. In particular, if we look at Asia and Japan, we are still remaining positive. If you look at consensus earning estimate, that has been revised higher so far for this year, led by North Asia, and that should support the regional equity strong performance versus US and Europe. And this trend to us is likely to continue unless the geopolitical uncertainty persists and oil prices remain elevated for a longer a period than we expected. I think nevertheless, this week events leaving fairly little room for complacency, and definitely it's time to manage concentration risk. And so rebalancing portfolio towards quality equities and bonds remain critical in this environment in our view.
All right. So you mentioned Asian equities, and I think that's obviously been particularly impacted from the rise in oil prices. But in terms of the preferred markets, sort of Chinese and Indian equities, could you elaborate a bit more in terms of what catalysts you're watching at this point in time that could trigger a reversal?
Sure. We believe the catalysts for China include the major internet companies' earnings reports in March, as well as policy support. While the decline in oil prices could be a catalyst for India. Let me delve a little bit more into this. In China, we do expect the internet and technology companies to show resilience earnings momentum, alongside a continuation of shareholders-friendly actions, including higher dividend and share buybacks. And we see constructive policy supports as China also target 4.5% to 5% growth in 2026. Any incremental reforms encouraging the shift of house saving into equities would also be the tailwinds for the China equity market. Now, for Indian equities, oil prices has been negatively impacting roughly 20% of the market. Thus, a de-escalation in the Middle East conflict leading to lower oil prices would definitely be a positive. And we also expect India earnings cycle to strengthen, driven by the US-India trade deal and resilient GDP growth supported by the 2026 and 27 union budget.
All right. And maybe very quickly before we wrap up, amongst the discussion of potential short-term hedges, I mean, the yen comes up as one potential safe haven. But is that likely to be the case in the current environment if the risk is driven by oil prices?
Yeah, I think, Manpreet, you bring up a good point of discussion. We do think that Japan's reliance on the Middle Eastern oil flow actually limits the yen's safe haven status this time around. The dollar yen is likely to stay range bound in our view, shall be hovering between 155 to 159. And Japan is obviously among the world's largest crude oil importers. They source approximately 95% of their crude oil and also 11% of its LNG from the Middle East. So roughly 70% of this oil passed through the Strait of Hormuz, and therefore making Japan very vulnerable to the transit and supply risk. So given the current volatility in the region, we think that the yen is unlikely to be the most reliable safe haven currency in the current environment. Now, if we look at the dollar yen pair, in our view, it actually faced upward pressure due to the heightened tension between U.S., Iran, and Israel. However, any sharp moves are likely to be prompting FX intervention from the Japanese government. And overall, we do anticipate the pair to encounter significant resistance around 159 yen to the dollar, and we shall see support near around 155 yen to the dollar.
All right, Ray. I think we'll bring the conversation to an end there, as I think we've run out of time. But thank you for taking the time to speak to our listeners today. If I can just summarize the top takeaways, I think number one is that in a range of scenarios, we'd prefer, of course, putting short-term hedges in place. Given our base case scenario that disruptions last weeks rather than months. That's the first key takeaway, and good example of that, of course, inflation-protected bonds or traditional hedges like gold. Second is that in this context, the US dollar, of course, benefiting in the short term as a near-term hedge. And third, of course, when thinking about some of the potential opportunities that could arise in the long run, obviously, watch China and Indian equities, and particularly the catalyst we discussed as potential triggers for performance in those markets. So thank you very much, listeners, for listening to the podcast today. We hope you found that useful, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.